Evy, I want to use copper as a global proxy and particularly as a China proxy. Bring up the chart. This is a chart Evy Hambro knows well. This is inflation adjusted copper, real copper with long-term lowering deflation, a lowering price adjusted for inflation, the huge China boom, and then down we go recently, and then this huge ambiguous move here, Evy. What is your call on the direction of something as foundational as copper?
Yeah, it's a great question, Tom. I think copper's always been a barometer of world economic growth and activity. We're obviously seeing some slower data coming out of many of the economies around the world. So you've seen copper prices trade back below $3 a pound to the levels they're at today. However, the supply side of the copper market is the one that's really intriguing to us. A lack of investment into new supply, combined with high levels of disruptions this year and low levels of inventory in warehouses around the world does make the copper market look pretty tight. And as we look forward into the future, with demand likely to rise, with increased electrification, we've got the move to electric vehicles and so on that's taking place. The prospects for that demand-supply balance are ones where we should start to see copper prices trading higher rather than lower.
Evy, buried in your report is a single sentence that's crucial. Free cash flow at mining shows a whole new world. They've really straightened out the expense side and that whole silly vision thing from 10 and 20 years ago. Have they really done it, or are they going to get stupid again?
Yeah, well, this is a subject we've talked about a bit, Tom, over the last year or so in coming onto this show. And I think that the evidence is the best thing to look at here. The companies have been resilient on their strategy. They've focused on free cash flow generation. They've focused on debt reduction. They haven't been spending money unwisely, and they've been returning surplus cash back to shareholders. I think all of these factors, when you put them together, make a very compelling story for resource equities. When you start to see some of the challenges that many other companies are struggling through with regards to technology and the disruption that's taking place to their existing businesses, when you look at the payout ratios of dividends of some kind of core dividend companies that many people own in their portfolios, and they're relying on those for income, with the resource companies having little debt, very, very well-covered dividends, and these very high levels of cash flow generation, I can't understand why the sector isn't better rated than it is today.